Hey everyone, welcome back to our channel, where we help you achieve financial success. In today's video, we're going to be discussing the habits of highly effective investors. You may be wondering, what sets successful investors apart from the rest? Well, the truth is that highly effective investors have developed a set of habits that allow them to invest right and win big. By the end of this video, you'll be able to identify these habits and apply them to your own investing strategy. Habit 1. Research, research, research. One of the most important habits of highly effective investors is that they are always researching. They understand that knowledge is power, and the more information they have about a company or an investment, the better they can make informed decisions. They read financial reports, attend investor conferences, and keep up to date with the latest news in their industry. This habit allows them to identify opportunities that others may have missed and make smart investment decisions. But what should you look for when doing research? First, analyze the company's financial statements to understand its revenue, earnings, and debt levels. Second, study the management team and their track record. Do they have experience and a proven track record of success? Finally, look at the company's competitive landscape and consider any potential threats or opportunities. Habit 2. Invest as early as you can. Albert Einstein, one of the most brilliant scientists of all time, was not just a master of physics, but also understood the power of compound interest in creating wealth. He once famously remarked that, "Compound interest is the eighth wonder of the world." Compound interest is a simple yet powerful concept that allows you to generate significant wealth over time by reinvesting your earnings. It is essentially interest earned on both your initial investment and any accumulated interest. This means that your money grows exponentially as the interest is compounded over time. Investing early and consistently is key to harnessing the power of compound interest. Let's take the example of two individuals, Tammy and Patrick. Tammy starts investing $5,000 at age 25 and adds $2,500 per year for the next 40 years, earning an average annual return of 7%. On the other hand, Patrick starts at 35 years of age and invests double the initial sum that Tammy invested, which is $10,000. He invests $5,000 per year over the next 3 decades until he reaches 65. Assuming the same 7% annual return for Patrick, it may come as a surprise that Tammy ends up with more money than Patrick when both reach 65 years old. Tammy's investment portfolio grows to almost $609,000. While Patrick's pool of money will only grow to around $581,500. This is because Tammy has a longer time horizon, allowing her to compound her returns over many more years than Patrick. By investing early and regularly, Tammy was able to achieve a larger sum than Patrick, even though she invested less initially. This example highlights the importance of starting early and regularly investing in your portfolio. By getting into the habit of investing early, you give your money more time to compound, and your portfolio will grow significantly over time. In addition, it's important to note that the power of compound interest is not limited to just stocks or mutual funds. It can also be applied to other types of investments, such as bonds, real estate, and even savings accounts. By reinvesting the interest earned on these investments, you can grow your wealth even further. The power of compound interest is a valuable tool for creating wealth. By starting early, investing regularly, and allowing time for compounding to work its magic, you can achieve financial success and build long-term wealth. Remember the wise words of Albert Einstein and start harnessing the power of compound interest today. Habit 3. Have a long-term mindset. Another key habit of highly effective investors is that they have a long-term mindset. They understand that investing is a marathon, not a sprint. They don't get caught up in short-term fluctuations in the market, and instead focus on the long-term potential of their investments. This habit allows them to avoid knee-jerk reactions to market fluctuations and stay focused on their long-term goals. To illustrate this point, let's take a look at Warren Buffett, one of the most successful investors of all time. Buffett's investment philosophy is centered around buying great companies and holding them for the long term. In fact, he famously said that his favorite holding period is forever. By taking a long-term approach, Buffett has been able to generate enormous wealth for himself and his investors. Habit 4. Diversify your portfolio. Highly effective investors also understand the importance of diversification. They don't put all their eggs in one basket and instead spread their investments across a variety of different asset classes, industries, and geographic regions. This habit allows them to minimize their risk and maximize their returns over the long term. But how do you diversify your portfolio? First, consider investing in a mix of stocks, bonds, and cash. Second, diversify across different industries such as technology, healthcare, and finance. Finally, consider investing in international markets to reduce your exposure to domestic economic risks. Habit 5. Have discipline and patience. Successful investors also have a great deal of discipline and patience. They stick to their investment plan even when the market gets volatile, and they don't let their emotions get in the way of their decisions. They also understand that investing takes time and that the best returns often come to those who are patient and disciplined. To highlight this habit, let's take a look at Jack Bogle, the founder of Vanguard and a pioneer of index investing. Bogle's investing philosophy is centered around low-cost, passive investing and a buy-and-hold strategy. By sticking to his disciplined approach, Bogle was able to create enormous wealth for himself and his investors over the long term. Habit 6. Reinvest your dividends or capital gains. It's always a great feeling to get a dividend. When you get a dividend, you are always happy to see your bank account grow. You can spend some of your dividends on a good meal or a vacation, but you should think about putting the rest back into the stock market. You can speed up the process of compounding and get even more dividends the next time they are paid by buying the same stocks that gave you these dividends. The same method can also be used for capital gains. You can put the money you get from selling stocks back into other companies that look good. If you keep putting money back into the market, your money will grow much faster. Habit 7. Continue to learn and evolve. Lastly, highly effective investors are always looking for ways to improve and evolve. They don't rest on their laurels and instead continue to learn and adapt to changes in the market. They understand that the investment landscape is constantly evolving and that staying ahead of the curve is crucial to success. To illustrate this point, let's take a look at Ray Dalio, the founder of Bridgewater Associates, one of the largest and most successful hedge funds in the world. Dalio is known for his principles approach to investing, which involves constantly learning and evolving based on feedback and data. By embracing change and constantly looking for ways to improve, Dalio has been able to create tremendous wealth for himself and his investors. So, now you know the habits of highly effective investors. By researching thoroughly, having a long-term mindset, diversifying your portfolio, having discipline and patience, reinvesting your dividends, and continuing to learn and evolve, you can invest right and win big. It's important to remember that investing is a journey and success doesn't happen overnight. But by adopting these habits and staying committed to your investment strategy, you can achieve financial success and build long-term wealth. Thank you for watching, and don't forget to subscribe to our channel for more financial tips and insights.